Today's video is on PayPal, as many people have been calling it PayPal, and I want to tell you exactly why I'm so keen on buying more shares at $50 per share. And the reason is I really want to bring down my cost basis, and I would love that to happen. I know it sounds a bit weird, right? Because I mean, typically everybody wants prices to go up, but here, we do things a little differently. You know that I like to buy great companies when they become cheaper, and that is certainly the case with PayPal. I don't think the fundamentals have deteriorated at all. In today's video, my goal is to just break everything down to you. Okay, so I want to let you know exactly why I will be buying more shares at $50 per share. It's not financial advice, okay? So you always have to do your own due diligence, right? So make sure you are not pulling the trigger on this company just because I say so, but this is what I'm doing with my own money, okay? And I'm very transparent, as you guys know, and so I'm letting you guys know. First things first, I'm very happy because one of our events right here that we posted this on LinkedIn like a week and a half ago, and already over 100 people have joined so already over 100 people have already signed up. This is going to be a live webinar, and the key theme is around why most investors actually underperform and how to fix that. So how to stop sabotaging yourself. Okay, so I'm not sure if any of you guys are following me on LinkedIn. If so, please, perhaps this will come in handy, and you can enroll. It's entirely free, and it's going to be 1 hour of a lot of content. So I will share exactly many of the things that I've already been sharing here with many of you, but it's going to be a jam-packed session. So make sure you bring your notepad. Okay, fantastic. Another thing that I want to say, thought of the day. We shared, where is this? Let me go here to the profile, and one of our posts that I think is very important as well. So let me share this with you. Show all posts. Where is that? Where is this? Let me make sure I have this here for you. It's not this one, so bear with me. Yes, it's exactly this one right here. And a big shout out to Pallavi, which has been doing a phenomenal job. I'm not sure if she will be watching this video, but she is working with me, so she does a lot of our posting on LinkedIn. So big shout out to her because I really think she's doing a fabulous job when it comes to communicating our message. Okay, so you can see that we always use this follow pillar castle defense. Okay, as she puts it, and rightly so. So we always make decisions around these 4 M's that I learned from Phil Town. The first one meaning if you don't understand what the company does, you are not investing, you are actually gambling with better formatting, right? The second one is the moat, competitive advantage. So you can imagine your business like as a castle, and if you don't have a moat, brand, patent, or cost advantage, or switching costs, or network effects, whatever, the barbarians, so the competitors, are coming for your treasure. No moat, no investment. So I never invest in no moat businesses. Okay, that's one thing that I rule out. So whenever you guys bring me like a new companies that are just starting out, what's the moat? How can you possibly tell a moat when how can you possibly understand whether the company has a moat if they have only been around for a few years? So you don't have a track record. Okay, it's much more difficult to understand that moat without having many years of consistency and predictability in the numbers. Management, I look for skin in the game. If the CEO doesn't own a chunk of the company, well, they are not really a partner, they are a babysitter, and babysitters don't always care if the house burns down as long as they get paid. Look, this is a bit extreme, and I personally invest in some companies that whose management team doesn't have a lot of skin in the game. That said, you will be making a sound investment decision if you really trust your money with someone who has a lot of skin in the game. And sure enough, most companies in our very concentrated portfolio are in this category, which is very important. And then, of course, last but not least, margin of safety. This is where most people fail. They confuse price with value. Buying a great company at a terrible price is always a terrible investment. The Tortoise secret: 90% of the work happens before I click buy. I avoid capital-intensive headaches like airlines and mining, where profits go to die, and focus on high ROIs, with return on invested capital, and effective capital allocation. Okay, so very important framework for you guys watching this video right now. And for those of you who've been watching the channel for a while, then you know that this is what we live and breathe. We love this stuff, and we will continue to execute on it. Now, let's hop right into today's subject. And as always, I took the liberty to put everything in a Word document right here, just to make sure I don't miss out on any key points, okay? Because this is important. So for those of you following the channel, and I know many of you have followed the channel exactly because you were particularly interested in some of my holdings, namely PayPal and Lululemon. So let me give you a brief overview of this company, okay? Starting with this introduction right here. The goal, so the PayPal is one of the most controversial large cap stocks in the stock market today. Growth has slowed, competition is fierce, and the market has largely written the story off. Yet, at around $56 per share, which is today what the company is trading at today, and especially closer to 50, PayPal starts to look less like a struggling fintech and more like a misunderstood cash-generating platform with multiple levers of growth still intact. Okay, so what I will be doing throughout this video is I will discuss the business model evolution. I will discuss why the market is skeptical, why that skepticism may be overdone, in my humble opinion, how shareholders are paid to wait, because that's exactly what's happening right now, and I will touch upon valuation and risks, okay? So starting with PayPal's business model and the new CEO, Alex Chriss, who took over in, I believe, October 2023, the shift to a multi-engine commerce platform. The key message here is PayPal is no longer just branded checkout. That was the case a few years ago, certainly before Alex Chriss. But now, with this management team, the company is shifting right from a purely payments company to a full e-commerce business. And that's part of the reason I invested in the company, because I wanted a different business model. And I also wanted a management team that was more shareholder friendly. Okay, and so under CEO Alex Chriss, PayPal has been repositioned from a single product checkout company into a multi-engine commerce and financial platform. So core engines today, and we see that right almost on a weekly basis, that if you are following PayPal, you know that it seems that every single day the company announces new partnerships. So the core engines today include branded checkout, yes, mature but still massive, and we will discuss why the market is overly focusing on branded checkout. Venmo monetization is improving substantially. Same thing with buy now, pay later. Then we have debit and financial services. We have agentic commerce and AI-driven payments. And last but not least, we have ads, crypto, and potential banking services, because this is something that PayPal is currently doing. So they want to start lending money as well and operate as a bank, which is another level of growth. So the shift matters because PayPal is moving inside commerce flows, not just sitting at the end of a website checkout. It's no longer a payment service provider. A key example: PayPal debit card users transact nearly 6 times more, generate 3 times the average revenue per account of checkout-only users. This is not incremental, it's a structural upgrade in user value. And buy now, pay later shows a similar pattern. So we have installments increase engagement across the entire account, not just one transaction. Okay, and if you can go back to my to one of my previous videos on the quarterly earnings report that they released, and you can see how fast PayPal, buy now, pay later, and Venmo products have actually been growing. Okay, which is something that I really, really like a lot. Why the market is discounting PayPal, even though we see all of this happening? The key message, guys, is that the market remains fixated on the weakest engine. But the weakest engine also happens to be arguably the most important, and that is branded checkout. Okay. So the market skepticism centers on slowing branded checkout growth. And Alex Chris has mentioned that they have to turn this around. So the total payment volume growth still hovers around 5% in the recent quarter, which coincides with past growth, and the market is concerned that this number here will decline as competition in the space heats up. Okay, and so we have heavy competition coming from card networks, big tech wallets, like think of companies like Google Pay, Apple Pay, in Amazon Pay. I mean, whatever, right? There are so many, but Apple Pay and Google Pay are some of the most important ones, of course. Local payment champions internationally. So concerns that branded checkout continues losing share. Let's just say all things equal, in the next quarter, the branded checkout experience would increase from 5% to 6 or 7%. I think that alone will cause the share price to go ballistic. And the reason is the market is greatly discounting all of these potential the market is discounting these headwinds, but and that has significantly compressed the multiple to levels not seen in many years. And so when a positive tailwind like this one, which would work as a catalyst, comes into the picture, then that would be enough to reprice the company. Okay. And so this is why major banks like Morgan Stanley, Bank of America, and Deutsche Bank maintain neutral to hold ratings with price targets close to today's price. So accelerating the downward pressure is the fact that many of these leading financial institutions have been downgrading PayPal already in the dumps. You can't make this stuff up. Now, I always take analysts' ratings with a grain of salt, because I know from experience that their opinion follows trend. These are the same analysts that were downgrading PayPal at 54 and are now upgrading PayPal at 100 at almost almost $170 per share. I mean, you really can't make this stuff up. And so I like to read what they put out, because I think it's research driven, and I like that, of course, as an educated investor. However, whenever it comes to buy ratings and sell ratings, I always like to rely on my own personal due diligence. Okay, because remember, at the end of the day, they have jobs. Okay, so I mean, what do you think will happen if the majority of them say that, for example, they are downgrading PayPal, PayPal actually goes lower, and then there is one analyst that actually upgraded it. His job is going to be at risk. Okay, it's just how this works. So, to the market, PayPal looks increasingly like a slow-growing financial utility rather than a global commerce platform. That perception explains why the stock trades at roughly half its historical multiple. And sure enough, if I head over to stock analysis, and if I go here to the financials and here to metrics, you can see that so PayPal is already a mature business, so the price to earnings ratio or the price to free cash flow are good metrics to use. If you look at the price to earnings on a yearly chart, on a yearly time frame, as a matter of fact, you can see that this is one of the lower. In fact, let's put this right here, trailing 12 months. Look at this. So the lowest point since 2018, the lowest level is around 12. Right now, we are just at 12.83. Okay, this is the lowest valuation the company has traded at. I mean, it's incredible from a price to earnings standpoint. If we look at the price to free cash flow, again, if we do the trailing 12-month figure, you can see that this is also one of the lowest valuation multiples in the company's history. Okay, so let's continue. Okay, why I think the market is wrong. The key message that I want to highlight is the market is pricing PayPal as a melting ice cube. The cash flows say otherwise. While checkout is maturing, PayPal has already diversified its revenue drivers. So the market is overly focusing, right? So it's too obsessed with the company's branded checkout experience, which still is the company's bread and butter right now, right? Because it drives most of the company's profitability. But it's so when you buy PayPal today, it's like all the other growth levers that we've discussed. You can buy them entirely free. All right. So under the surface, what exactly are the financials telling us? They say that the revenue continues to grow at 7% year over year. Oh, and by the way, this actually accelerated from from last quarter. Normalized earnings per share are up double digits year over year. Trailing payment volume up 8% to 458 billion, and transaction margin dollars are up 6% to 3.9 billion. So the question that I have for you, dear viewers, is: does this look like a dying business? No, and yet it's trading at one. This is not hyper growth, but it's also not a broken business. Management intentionally pruned low value PSP volumes. We discussed this at length as well. They are shifting from lower transaction counts. In other words, they are firing these low margin accounts, and because they want to improve their margins, so they want customers that actually bring more value to the ecosystem. And so this makes a lot of sense, and it explains why we saw a 5% decline in transactions. Okay, but it was intentional. Okay, and it's exactly because of this shift toward higher margin, to higher value transactions. Okay, focused on higher quality cohorts. Active accounts are maturing. They still grow at about 1%. But look, PayPal already has over PayPal has, I mean, what? I mean, I think it's 400 million users. In fact, over 400 million users. And so it's very difficult for PayPal to grow its average accounts by more than 1%. I mean, can we imagine that? I mean, they are already so well established. For us to see a greater acceleration, I mean, it's probably a bit of a stretch, but certainly they can improve from these levels. Okay, yeah, but still, revenue continues to grow at high single digits. Earnings are growing double digits, so this is discipline optimization, certainly not a decline. The strategic optionality the market is ignoring. Key message: PayPal is embedding itself in the next gen commerce. PayPal most underappreciated move is definitely agentic commerce. Highlights payment infrastructure for 700 million weekly ChatGPT users. Partnerships with OpenAI, Google, Mastercard, Perplexity, and more recently, and by that I mean last week, I believe. Well, actually, no. Just a few days ago, they announced a new partnership with Microsoft. So today is the 14th of January. I think this was on the 12th, if I'm not mistaken. Merchants can plug into AI-driven commerce flows without building payment rails. This positions PayPal inside conversational commerce, not just a traditional checkout. Whether or not so, regarding aging agentic commerce, Alex Chris continues to stress that aging commerce is the future, but we are still years away from a potential monetization. Okay, and so this, what PayPal is doing right now, is laying the right foundation. So they are planting the seeds for what can be exponential growth in the years ahead. Okay, so, and of course, the market doesn't really care about that because most market participants are short to medium term oriented, but we are long-term investors. Okay, so this is something that, sure enough, will be of great interest. Add to that expanding crypto capabilities, adds layered on transaction data, potential banking services pending regulatory approval. So none of these will move earnings overnight, important, but they represent real optionality that the market is valuing close to zero. And if you have been following the channel, you know that one of the things that I really like in an investment is plenty of optionalities. Okay, so for example, I don't really have that with Lululemon, which is another one of our core holdings. Lululemon, so it's an apparel giant. They focus on the athletic apparel space, but that's it. So if there is a slowdown in that category, the whole company will struggle. So the reason I invested is in Lululemon is different from the one that I would invest in a company like PayPal or Alibaba, which give me multiple optionalities. And this typically is what you should look for in an investment. So always have plenty optionality, multiple so levers of growth, which is what we want, because that will add to your margin of safety. Okay, so very important. And so shareholders are being paid to await. Why? Let me explain. The cash flow math is compelling. PayPal is generating 6 to 7 billion in annual free cash flow. And sure enough, management has guided for around 6 or 7 billion, between 6 to 7 billion at the end of 2025. So let's call it 6.5 billion. And that is against a market cap of 54 to 60. The current market cap of PayPal, let me have a look right here, is so yeah, that is against a market cap of about $53 billion. I mean, it's just incredible. Okay, so what does that mean is that the free cash flow yield right now stands at about look at this, almost two digits, so 9.29%. In other words, if you bought the whole company today, yeah, this means that you will be able to collect say almost 10% in earnings on a yearly basis. Okay, assuming current earnings will not grow, they will just stay the same. How about that? Okay, let's continue. So capital returns, 5.7 billion in buybacks over the last year and 6.5 billion expected in 25 overall. So this means you have a 10% of the equity base retired annually, guys, right? That is just unbelievable. So even with flat earnings, if you do the math, this means that earnings per share can grow at about 10% per year purely from buybacks. I'm not going to buy any company. So imagine that would I invest in a company with no growth, that was not operating in a secular market, right? Just because of buybacks? No, of course not. But but what's truth is, it is again is the icing on the cake, because it adds more to our margin of safety. Right now we have a company that is still growing, but even if they don't grow, okay, even if we assume flat earnings, this means that they can still, earnings per share could still grow at about 10% purely from buybacks. On top of that, they announced the dividend, which is quite small, but it's also another so it's another thing going for us shareholders, because it's so it means the company saying, hey guys, here's this small dividend as you wait for the company to turn around. This is how I see it. Okay, so it's not a buy signal for sure, but it's a signal. By that I mean, don't just buy the company for the dividend's sake, of course, but it's a sign of durability and confidence. And then, of course, we go back to the valuation levels and why the $50 range matters. This is a valuation-led thesis. Assumptions: long-term interest rates normalize around 5% implies a fair multiple near 20 times price to free cash flow. What I want to discuss right here is that we right now, is certainly in the United States, we are on the verge of, in fact, the Federal Reserve has been cutting interest rates. And what do we know about that? We know that when they start cutting interest rates, they make borrowing money cheaper. And sure enough, the company's valuations can trade and will trade at higher valuation multiples, exactly because money is made cheaper. And so that alone can add another catalyst to PayPal, something to pay attention to. So what do we have? We have forward earnings per share bit of 5.35 to 5.39. This is the earnings yield, as we already discussed. The implied free cash flow yield is around is about 11 to about 12.5%. Yes, because if I go here, you can see that the current free cash flow is about 5.95, but they are guiding for 6.57. They are guiding for 6 to 7, so let's call it 6.5. And if you consider if you consider 6.5 billion and on today's market cap of about 53 billion, that will give you a double-digit free cash flow yield of around 12%, which is insane, guys. Okay, absolutely insane. And so we have the stock trading at forward 8 to 9 times free cash flow, which is 55% below its 5-year average multiple. And so at 50, you are effectively being paid double-digit cash returns while waiting for sentiment to normalize. But the key reason is right now, my cost basis on this company is around $64 per share. No, excuse me, $67 per share, which means that I'm underwater right here. And so at 50, I will have already a big an important level to add more money to it, okay, to bring that cost base to basis lower. And in fact, if I show you the charts here, let me show you right here. You know that our approach, again, if you are watching the channel for the first time, our approach is 90% fundamentals and 10% technicals. And so if I go here to PayPal right now, you can see that the $50 mark coincides with the strong level of support, and it will definitely mark a double bottom, which in my world is very, very bullish. Okay, so look at that. This is where I bought around 67, if I'm not mistaken. So if I bought at $67 per share, from these levels right here to 50, that means that I would be adding more when the stock is at about 25% lower than my current cost basis. All right, and it will coincide with an important bottom that was hit on October in October 2023. Okay. By no means am I saying the company cannot continue to go cheaper. This is why cannot continue to go to become cheaper, right? So go lower. This is why you have to do your own due diligence. I'm only telling you what I will be doing with my own money, okay? So I want to increase my exposure because I see the fundamental improvements in a significantly undervalued company, and because I think 2026 is going to be the year of PayPal. You can quote me on that. Maybe I'm completely wrong, but this is my understanding. There is only so much that you can continue. So there's only so much pressure that the company continue to, that the fundamentals, well, there's only so much pressure that the stock can be facing with improving fundamentals. At one point, I think this thing will explode, okay? So, and it may very happen this year, okay? But I'm not in the business of timing the markets, as you know. And so this is what I will do. All right, cool. And by the way, I only use eToro for executing my transaction. Excuse me. I only use eToro for educational purposes, but I use Interactive Brokers to execute all of our portfolio transactions. Okay, this is what I use with clients because it's more user friendly. So yes, and going back to what we were addressing, the key risks going forward. So you should clearly acknowledge brand checkout erosion, right? This is definitely a main risk. This continues faster than expected. AI agentic commerce monetization takes longer than hoped. Competition compresses margins, and this ties into what we just discussed right here. Rates stay structurally higher for longer, limiting multiple expansion. Remember when we discussed that we are now in an easing cycle with the Federal Reserve's lowering interest rates. What happens if inflation reaccelerates and they actually have to start increasing interest rates? It can add more downward pressure on a company like PayPal, even though we already have a significant margin of safety relative to the company's value. Okay, so the closing thoughts: at today's price, PayPal is priced like a slow financial utility, yet it generates double-digit free cash flow yield, shrinks its share count massively, and still grows earnings faster than a median S&P 500 company. Okay, and at $50 per share, the margin of safety improves meaningfully. This is not a stock you buy for hype. It's one buy because cash discipline are being ignored and so forth. Okay, very, very important. And another thing that I want to show you before we wrap things up is what is the recipe for a big turnaround? What are the main things that I'm after? Improving margins. Growing revenues, growing earnings. This is all things that are important. And if I go here to our gross margin, what can you see? You can see that since Alex Chris took over at the end of 2023, gross margins have been accelerating. Very good. What else can we see on a quarterly, on an operating margin basis? You can see that since 2023, operating margins have been accelerating. What can you see? Net margin. You can see that since Alex Chris took over, net margin has been accelerating. And last but not least, free cash flow margin. You can see that it has been accelerating as well. It went up, down, but remember that they are guiding for 6.5 to 7 billion free cash flows at the end of 2025. And so this will be the highest free cash flow levels that the company, it will be the highest free cash flow that the company has ever generated in its history. Very, very important. And yet you have one of the lowest valuations. In fact, the lowest valuation levels. Isn't that beautiful? So exactly, guys. Look, I hope you managed to gain value from today's video. If so, make sure you smash the like button because it takes quite a long time to actually put these videos together and prepare everything. And let me know in the comments if you really like that and if you want me to put out more content like this one. Also, last but not least, look at the improving metrics around capital returns. So in terms of allocation, if I look at return on equity, look at that, improving. If I look at return on assets, improving. If I look at return on capital employed, improving. If I look at return on invested capital, boom, improving. Okay, I love that. Everything is improving while the price is declining. This is what will allow us to make a lot of money over time. If we pick a handful of companies that match our criteria for quality, but they are heavily depressed on a price basis, this is what long term is going to dictate who's going to make the most money, who's going to be very, very successful in this business. Okay, stick around for more, guys. Thank you so much for your value contribution, and don't forget that at the end of this month we have our live, so you can guys. So you guys can ask me any questions, okay? Thank you. Stay tuned for more.